You read the headline. The economy is growing. Stocks are rising. Companies are hiring. Then you open your banking app and wonder why your life feels like a very expensive practical joke. Your rent is higher. Your grocery bag is lighter. Your credit card balance looks suspiciously alive. So what exactly is growing? Because it does not feel like your wallet. This is the strange emotional math of the modern economy. A country can get richer on paper while your daily life feels poorer in practice. Because the official economy and your personal economy are not the same thing. One measures output, TOR. The other measures whether your paycheck survives Tuesday. In the first quarter of 2026, the United States economy was revised up to a 1% annualized growth rate. Annualized means economists take 1 quarter of growth and imagine what it would look like if that pace lasted for a full year. Nice number, clean number, very comforting on a chart. But consumer spending grew at only 0.5%. Consumer spending means the money households spend on food, rent, gasoline, insurance, travel, healthcare, subscriptions, and the tiny purchases that quietly drain your soul. It is also the largest engine of the American economy. So the headline said growth. Your bank account said friction. Which one was lying? Technically neither. The problem is GDP went by. Gross domestic product, or GDP, is the total market value of goods and services produced inside a country. In plain English, it is the national scoreboard for economic activity. It counts production. It counts transactions. It counts spending. It does not count your stress. Simon Kuznets, the economist who helped create national income accounting in the 1930s, warned that a nation's welfare could not be measured by national income alone. Translation: a bigger economy does not automatically mean a better life. But that warning was inconvenient. So the scoreboard became the story. And now you live inside the gap between the scoreboard and the grocery receipt. Imagine a city where 3 things happen at once. A tech company builds a massive artificial intelligence data center. A defense contractor receives a huge government order. And your landlord raises rent again. GDP sees investment. GDP sees production. GDP sees spending. Your wallet sees rent rate. That is the first reason you feel broke while the economy grows. Growth does not arrive evenly. It lands first where capital is already sitting. Capital is money that owns things. Labor is time that rents itself out by the hour, shift, salary, or project. When growth comes from software, equipment, data centers, stock prices, and financial assets, the first people to feel richer are the people who already own those assets. If you own shares in the winning company, you smile. If you only pay higher bills because every data center nearby is inhaling electricity, you do not. That is not magic. It is plumbing. Money flows through pipes. Some people stand under the main pipe with a bucket. Other people hold a paper cup 3 blocks away. John Maynard Keynes argued that aggregate demand matters. Aggregate demand means total spending across the economy. One person's spending becomes another person's income. But if your spending is being held up by credit cards, drained savings, and anxiety purchases, the economy can still record activity while your personal balance sheet gets weaker. Your swipe becomes GDP. Your interest payment becomes bank revenue. Your stress becomes invisible. Now, add inflation. Inflation means prices rise, and each dollar buys less than it used to. It is not just that things are expensive. It is that yesterday's money quietly shrinks inside today's store. In May 2026, the Personal Consumption Expenditures Price Index, called PCE, rose 4.1% from a year earlier. PCE is one of the Federal Reserve's favorite inflation gauges because it tracks a broad basket of consumer spending, adjusts when people switch products. If beef gets expensive and consumers buy chicken instead, PAE tries to capture that behavior. Because your brain does not experience inflation as a percentage, your brain experiences it as betrayal. You remember when the same grocery run cost less. You remember when rent did not eat half of your paycheck. You remember when a car payment did not feel like leasing a small private island. Daniel Kahneman and Amos Tversky helped explain this with prospect theory. Prospect theory is a behavioral economics idea showing that people feel losses more painfully than equivalent gains. In plain English, losing $100 hurts more than gaining $100 feels good. So when your wage rises but food, rent, insurance, and debt payments rise faster in the places you actually spend money, your spreadsheet might say you are almost keeping up. Your nervous system disagrees. It feels like loss. And loss gets attention. This is why official inflation can fall, and you can still feel angry. Inflation slowing does not mean prices go back down. It usually means prices are still rising, just more slowly. If a $5 item becomes $6, then rises to $6.18 next year, inflation has slowed. Congratulations, you are still paying $6.18. Now, look at debt. By the end of 2025, total U.S. household debt reached about $18.8 trillion, with credit card balances around $13 trillion. Household debt means money families owe on mortgages, cars, student loans, credit cards, and other borrowing. It is not automatically bad. A mortgage can buy shelter. A student loan can buy education. A car loan can buy mobility. But high-interest debt is different. It is not a bridge. It is a treadmill. Credit card interest turns yesterday's groceries into tomorrow's financial punishment. You bought dinner once. The bank keeps eating. Richard Thaler, one of the founders of behavioral economics, called this kind of behavior mental accounting. You do not treat all money the same. A tax refund feels like free money. A credit card limit feels like buying power. A subscription feels tiny until 10 of them form a little financial parasite colony. So the economy grows. Retailers get revenue. Banks get interest. Payment processors get fees. You get a minimum payment. The minimum payment is one of the most elegant traps in modern finance. It whispers that you are handling the problem. It gives you a number small enough to avoid panic. But if the interest rate is high, the balance can barely move. You are not climbing out. You are renting the illusion of progress. This is why the phrase consumer resilience can sound insulting. Economists use it to mean households keep spending despite pressure. Financial journalists use it to explain why the economy has not cracked, but inside your apartment. Resilience can mean something else. It means you paid the bill late. It means you used savings for groceries. It means you skipped the dentist. It means you chose between repairing the car and making the card payment. From far away, that still looks like spending. Up close, it looks like erosion. Now reconstruct the financial life of an ordinary person. Your salary is $60 a year. After taxes, healthcare deductions, retirement contributions if you can afford them, and other payroll bites. Suppose you bring home about $3,800 a month. Rent takes $1,700. Utilities, phone, and internet take $350. Groceries take $600. Car payment, gas, insurance, or transit take $750. Health costs, household supplies, clothes, and basic life maintenance take $500. That leaves roughly negative $100 before emergencies, repairs, gifts, travel, subscriptions, or the completely unreasonable desire to enjoy being alive. So what happens? You do not declare a recession. You use a credit card. Then the macroeconomic report says consumer spending remains resilient. After a few months, your credit card balance is $30. At a high interest rate, that balance becomes sticky. Sticky means it does not disappear easily because interest keeps adding weight. You make payments. The number shrinks a little. Then the car needs tires. The number grows again. You feel irresponsible. But the system is designed to make ordinary instability look like personal failure. This is the second reason you feel broke during growth. Your costs are fixed, but your income is fragile. Rent does not care that your hours were cut. Insurance does not care that groceries got expensive. A student loan servicer does not care that your car battery died. Prices update instantly. Wages negotiate slowly. That lag is where your anxiety lives. Milton Friedman described inflation as a monetary phenomenon, meaning it has deep connections to the supply of money and credit in the economy. But for your daily life, inflation is also a timing problem. Businesses can raise prices today. Your paycheck might not adjust until next year. Your landlord can renew the lease upward in one email. Your career cannot magically renew itself at a higher salary by Thursday. So even when wages rise on average, averages can hide the knife. If a senior engineer gets a $30 raise and a cashier gets 40 cents an hour, the average worker appears healthier. The cashier still cannot afford eggs, rent, and a surprise dental bill at the same time. This brings you to wealth. Income is what comes in. Wealth is what stays and grows. That difference matters more than almost anything. A high income with no assets is a fast river with no reservoir. It moves, it impresses people, then it disappears. Wealth is ownership. Stocks, homes, bonds, businesses. cash reserves, retirement accounts, assets that can rise while you sleep, which is extremely rude if you do not own any of them. When interest rates are high, asset owners and debtors can live in opposite economies. A saver with money in treasury bills may earn more interest. A borrower with credit card debt, auto loans, or an adjustable mortgage may bleed more interest. Jack Bogle, the founder of Vanguard, built his investing philosophy around owning broad, low-cost index funds. An index fund is a basket of many stocks designed to track a market instead of betting on one company. The boring idea was that if capitalism grows over decades, the patient owner can capture part of that growth. But you cannot invest money that gets eaten by rent. The economy rewards ownership most generously at the exact moment many people are struggling to reach ownership at all. So the stock market rises, home equity rises, corporate profits rise, and you are asked why you are not happier. Robert Shiller, the economist known for studying market bubbles and housing prices, has shown that asset prices are driven not only by fundamentals, but also by stories, expectations, and emotion. Housing is not just shelter anymore. It is an investment vehicle, a retirement plan, a tax strategy, a scarcity machine, and the thing blocking you from adulthood with better lighting. When homes become assets first, and places to live second, the economy can celebrate rising home values, while non-owners experience those same rising values as exclusion. One person's wealth effect is another person's rent increase. The wealth effect means people spend more when their assets rise in value because they feel richer. If your stock portfolio climbs, you might remodel the kitchen. If your home value rises, you might borrow against it. That spending boosts GDP, but if you do not own the portfolio or the house, you are not feeling well. You are feeling the price of someone else's wealth. Here's the counterintuitive twist. Feeling broke is not always a sign that the economy is weak. Sometimes it is a sign that the economy is strong in a way that is expensive for you. A strong labor market can keep service prices high. A strong housing market can keep rents high. Strong corporate profits can support stocks while companies still raise prices to protect margins. Strong demand can keep restaurants, airlines, insurance companies, and landlords confident enough to charge more. Strength at the macro level can feel like pressure at the personal level. This is why the clean headline fails. The economy is not a person. It does not have a rent payment. It does not get surprised by a medical bill. It does not feel embarrassed checking out at the grocery store because the total is higher than expected again. You do. And your brain is tracking a much more honest index than GDP pie. It is tracking how many decisions you make before spending $20. It is tracking how often you say not this month. It is tracking whether your savings account feels like protection or decoration. So what do you do with this? Not panic. Panic is expensive. First, separate the national economy from your personal economy. The national economy can grow while your personal balance sheet weakens. That is not a moral failure. It is a measurement problem. Second, stop treating income as the finish line. Income is fuel. Wealth is the engine. The goal is to convert fragile income into durable ownership, emergency cash, debt reduction, retirement accounts, index funds, useful skills, and fewer fixed obligations that trap future you. Third, notice the tiny leaks. Subscriptions, food delivery, convenience fees, credit card, interest. Lifestyle upgrades that feel deserved because life is stressful. The system is very good at turning stress into spending and spending into someone else's revenue. Finally, remember the real scoreboard. GDP can tell you whether the economy is producing more. It cannot tell you whether your paycheck has breathing room. The stock market can tell you what investors expect. It cannot tell you whether your grocery bill feels sane. Inflation data can tell you prices are rising more slowly. It cannot undo the price increases already sitting inside your rent, insurance, food, and debt. So, the next time you read that the economy is growing, do not automatically assume your wallet missed the party because you did something wrong. Ask a better question. Who owns the growth? Who pays the cost? And why does your bank account feel like the only honest economist in the room? You read the headline, "The economy is growing." Then you open your banking app, and this time, you understand exactly why your life feels like a very expensive, practical joke.